What's up, YouTube? All right, so if you're new to the channel, this channel I've been calling for a stock market crash and a bear market. I basically have been saying we're heading into a bear market. I've been saying it for, the last year roughly, and that's back when we broke the trend line in the stock market, and all we did was back test. All of 2019 was a simple back test. So let's get into it. I'm going to go through the charts and we'll show you guys what we're talking about. Again, I want to keep pointing this out for anyone that's new who hasn't seen this, but here's your weekly chart. So here's your stock market. This is your stock market bull market over the last decade. And when we broke the trend, the purple line right here, when we broke the trend right there in 2018, that's when I basically said, okay, the trend's broken. We're going to go into a bear market. And all of 2019 with the Federal Reserve 180 and everything that they did was merely a back test of that trend line. And here's your back test. And I put out a video back in this range here where I said, okay, I think this is the stock market top. I think this is the top of the bull market, and I think we're heading south. And sure enough, I was 100% right, and we had the absolute collapse of the stock market. So this is the first leg down in the bear market. We're officially in a bear market now, and this is your first leg down. Usually you're going to have multiple legs down. They don't, the crash doesn't come all at once. You get it over a period of time, how a year and a half or 2 years or whatever that is. But this is your first leg down, nice impulsive leg down. And now we could head lower, or we could have some sort of a bounce. I think we probably head lower first. I think we head lower and then we'll get a bounce. So we'll probably start to get a bounce. We'll probably undercut these December 2018 lows here, which is not that far away at this point. And then we'll bounce. The bounce that we saw, let's go to the 1 minute chart. Look at this. This is plunge protection team is what this is. The president came out and said they're going to do fiscal stimulus in the last half hour of the market, and the market rallied, but it rallied in the last half hour. And so this is nothing that you want to bite onto. And in fact, I'd been kind of trading my short positions. I reestablished my short position at the end of the day, and I'll show you here. There's your resistance right here on the Qs, 192. And so if we mark that out, that's your hourly resistance right there, right around 192, 50 or so, 192.20. And that's where I grabbed it, was right up in here. And if you look at the after hours, we were down pretty substantial in the after hours. So I suspect when the futures open up, we'll be heading south again. And here's your futures. Here's your breakdown candle right here. And if we mark the futures out, you've got, right there, there's your level. And you can see, this probably goes back to here. We'll see. No, not quite. But, here's a breakdown candle right there. You found support right there. It was resistance right here. And we just kind of came right up into it. And here's your futures. They close out the futures after the market closed, and we had a rejection. So I suspect when the futures open on Sunday, we start to head south and head back down to this support right here at 7348 in the NASDAQ futures. And I suspect we're going to break and head south more. Again, what I'm looking for is probably an undercut of the 2018 lows. You got a lot more to fall in the tech sector, in the triple Qs. People are still trying to find protection or dip buying, I guess, in the tech sector. Apple. I mean, if you look at Apple, Apple hasn't had that big of a fall from the highs. Here's Apple, and it's, as of Friday, it's only down 15% from the highs. So people are still thinking this is a dip buying opportunity, and that's to be expected. When you have such a long extended bull market and dip buying has paid off for the entire bull market, when you're so close to the top, on that first leg down in a bear market, there's a lot of people who don't know that the bull market is over, and they think they just continue the pattern of buying the dip, and so that makes sense that you'll see that in that first initial leg down. However, I think this time the dip buyers are not going to be rewarded, and I believe that they will ultimately be punished for what they did. And look at this. I could adjust this line right here on Apple. You could make the argument here, if I roll this out on the daily, there's your 2009 lows in Apple. And as we scroll up, we kind of found support, undercut it a little bit here and there, but tagged it there from the top, tagged it right there. And then you can see we tagged it right there, rejected, and then broke out. Here's your breakout, came back, it held support. Excuse me. And then you can see right here on Friday, we pretty much closed right at it. So it's resistance. We closed right at resistance. Ultimately, this is a great level to short Apple. It's an objective level. So I think this makes sense that Apple probably opens lower on Monday, or just sells off when the market opens on Monday. So you might want to look at that. That's a possible short opportunity. I think that's a pretty good one. Again, just my opinion, not trading advice. Let's look at some other stuff. Yeah, so Qs, I think that we're right here at resistance, and in a bear market, you want to sell the rips. So there will be plenty of opportunities to get short throughout this bear market, but you don't want to get short on the major collapse. You want to get short as the kickback rally comes and everyone starts to think that the selling's over. That's where you want to start to get short. So for me, I took a half position right here at 192. If we move higher, then we've got 201. This is a great shorting area right in here. And so I would definitely be adding to a full position right in there. And that's just because that is your trend line for the bull market. We don't have as clean of a trend line on triple Qs as we do on SPY, but it's right in that area. So, and you can see if I scroll in, here's your daily. We found support right there, so you could adjust it slightly, but I'm gonna leave it right there. And that's because these two candles right here, we closed right at it, and here we rejected right at it. So we'll just leave it right there. If this runs up and tags that, I'll definitely be having a full short position right there. And then you'll get the next leg lower, or you should at least, which would be an undercut of the 2018 lows, most likely. That is gonna, we got a right around there. And so yeah, the next leg lower should undercut that and head lower, possibly even heading all the way down here. I'm sorry, the 2018 lows are all the way down here. I don't know if we'll get down there on the next leg lower, but I think we'll probably undercut this support line right here of roughly 168. So I think we head down and probably head down to this 160. Well, it's probably the December 2018 lows now that I actually look at it. So the next leg lower should bring us probably to an undercut, and then we'll get a rally. And then ultimately we're heading down here, most likely, either this T1, longer term T1 or longer term T2. I've had this on my chart for a year, and I've pointed it out, and nobody believed me that this seemed like not really possible, but I'm sure there's a lot more people that can see this as a reality now, or a possibility. Nothing's guaranteed, it's just a probability, but I think it's highly likely that we get down here. Lots of support down in this range, so I could see us running down and tagging this, and then maybe bouncing or coming down to this T2 and probably undercutting it a little bit, and then finding a lot of support right in there. So this is the target zone for the bear market. And then at that point, we'll have to evaluate. That might just be the second leg down to here. We could easily do a third leg, and of kind of a five legs down. But for now, we're just going to keep these on the chart and evaluate as we get down there. This fun, I do not own this. I bought some the other day, but I sold it for like a 1% loss, 2% loss, and it's a good thing because this thing absolutely collapsed It is, let's look at this. Yeah, I think we got a little lower to go on this, but you can see that, we came close, we did come into some support. If we look on the weekly here, you'll notice there's some support right there on the weekly, and we pretty much came down and fell short of tagging it. So maybe that's it for this one. It's interesting. It's something to kind of look out for and watch. It might be worth buying some if we can maybe undercut this a little bit. Everything's shut down, and this thing operates amusement parks, so everything like that is shut down. So they're just losing money, and they're or not making money. So all the earnings across the board were way overpriced, and everything has to be rebalanced. And again, it's the bear market scenario I've been talking about. Everybody's been saying earnings are great. Well, earnings have only been expanded due to multiple expansion, which is interest rates falling, and that's not a good way to look at earnings. That just shows, that's a fake earnings, adjusted earnings, basically EBITDA earnings. If you want to look at earnings, you want to look at what their earnings actually are, like how much revenue they're bringing in, and their revenue-based earnings have been declining. So stocks have been moving up in the bull market because it's been earnings per share, less shares due to the buybacks, but earnings have been falling, and that was a clear sign. Anybody that knew how to understand what that meant knew what to look for. It's just a matter of when the bear market was going to take hold, and I knew it was coming. I just didn't know when, and it's here now. So here's the bond market. We got to pay attention to the bond market, because the bond market is where the bubble's at, and really the corporate bond market. So this LQD is a investment grade bond market ETF, iShares Trust iBox investment grade corporate bonds ETF. So this gives us an idea of what corporate bonds are trading at, and this is where the real bubble's at, because of all the low interest rates. You had companies selling a ton of debt, and then they were using that money to buy back their shares and prop their stock prices up and make a bunch of money for the CEOs and the shareholders. But it was on the back of cheap debt, basically. Well, you've got all this debt. Now you have all these companies that had high stock prices, but they were saddled with a bunch of debt. And if interest rates rise, then this debt, they either have to pay it back with decrease, basically that's going to decrease their earnings and dividends and all that. It's going to affect all that. Don't think your dividends are safe, because look at your company's balance sheet, making sure that they are not oversaddled with debt, because if they have a lot of debt and they played that debt game, then the dividends are not going to be safe. But this is your corporate debt bubble that has pretty much popped. I mean, here's your collapse, and you don't see moves like this just straight down unless that's really a collapse. I mean, if you go back on this thing and look at the last time you saw a move like this, it was back in the 2008 Great Recession right here. So, here's your first leg down, and you'll chop, but we should have another leg down, and it doesn't take much, and this time the corporate debt bubble was really a bubble that it could be a lot worse than what we saw in the 2008 recession. It could be very bad. And what that means is pension funds are going to suffer, and it'll take a little while, maybe 6 months or so, and we'll start to hear about pension funds having real issues, but they should suffer. Unless this can be corrected, which I just don't think it can, because the bubble's been popped at this point. So now everything is resistance. Every time it moves up, it's going to have massive downward pressure. And what we saw on Friday was the Fed. The Fed basically, this is the buying that we're seeing. It's the Federal Reserve. They can't necessarily buy corporate bonds, but by buying the U.S. Treasuries, like here's the BND. This is the Fed. They basically pumped $1.5 trillion into the Treasury market, and so this is them. This is all the buying is the Fed, and so this is manipulation. You have to understand that, and this still is not. This couldn't even break resistance. You see here, here's your resistance right here, 84. And yeah, we couldn't even break it. So most likely going to head south again. And what you'll notice in this crash that I'm seeing is the bond market and the stock market are crashing kind of at the same time. You've got bonds selling off, which means interest rates are rising, putting pressure on debt mechanisms like the corporate debt market. And if the corporate debt market, the interest rates rise, then a lot of those really low rated investment bonds, the triple Bs, are going to be downgraded to junk. The rating agencies will have to come out and downgrade them to junk. And when they do that, the Federal, or not the Federal Reserve, but the pensions and a lot of hedge funds have to buy, with their bylaws, they have to sell those, and they cannot hold junk debt. They have to hold only investment grade. So they're being forced out of these corporate bonds at any price, at a loss, basically a major loss, and that wrecks their math, basically. That wrecks their math allocation of how much they can actually pay out and whether they can support the commitments they've made. And that means they can't support the commitments that they've made. And with more and more baby boomers retiring, it's putting more and more demand or pressure on how much they need to pay out. And with a big loss like this, it's just the math doesn't add up. So you're going to see pensions come out here in probably 6 months and start to cut payouts and start to revise down. And it's going to be bad. I mean, that's just going to kind of further exemplify the recession that we're heading into. So keep an eye on that. The bear market's just getting started. The recession's just getting started. This is not a good buying opportunity. You'll see people saying good opportunity to buy the dip. You're going to hear about that a lot. That's not that's not how you play this. Yeah, you can trade it. There are rips that you can trade, and I will be trading, long and short throughout this crash. But if you're, a 401k holder or a longer term kind of investor, then this thing is going to head farther south, and we are going to have more selling. So it's not a good opportunity to buy. There will be a time where we'll flip on this channel. We'll flip bullish. And at that time, most people will be completely bearish, thinking the market's, in the gutter, everything's horrible, and we'll start flipping bullish. And the charts will tell us when that time comes, but we're not there yet. So we will continue to let this thing come down, because in reality, I have these targets right here, but I don't know how far it's going to go. This could go to here. We could stop here, and that might be the end, or we could easily come all the way down and undercut. We could undercut these 2008 lows, and that's a probability. Okay, right now it's a low probability because we're up here, but as we start to work our way down and see what unfolds, the probability could increase, and an undercut of these lows would probably put us in cheap, the cheap range. Stocks would be cheap. And at that point, if we were down there, it would be a time to be extremely bullish and extremely greedy, buying up companies and buying stocks long. And we could easily get there. So don't think that this first leg down is the good opportunity to buy the dip. The reason why I say that is the chart is completely broken. And the bull trend is completely broken. We've now started a bear trend. Let the bear trend play out. The trend is your friend. And so we are in a bear trend. That means shorting is, selling the rips. If you don't have an account you can short in, then you can exit your longs on rips. Go to cash. Shorting is good. Obviously, I had a pretty good week last week shorting the market. And, I don't think bonds are a place to hide out in. I do think gold is the place to hide out in. Let's flip over to that. Gold took a real beating last week. And so, a lot of these miners just got destroyed, especially the juniors. They just got taken out to the woodshed. And so let's look at that. I know that that's a concern for a lot of people, but as I was evaluating it, what I tend to do is when you see things like that, I take a step back and look at the bigger range charts and try to understand, okay, is the bigger range picture broken? Same with the stock market. When I look at the SPY chart, I always keep an eye on the big picture, the bull market trend, and try to say, okay, is that broken? And I knew, and that was broken in 2018, so that's when I flipped bearish. Well, in the gold chart, I take a step back and I look, okay, is the bigger picture broken? And what I see here, here's your gold bullion, here's your weekly chart, and I see this uptrend, and we fell pretty much right to support. It undercut it slightly, but look at this big old undercut right here. We were all the way down here, and at the end of the day, ramped it up and closed just under that support. So, yes, it is under support, but just barely. So it's anybody's game right now. This doesn't necessarily have to be broken. The level that you would want to really look at would be probably right there. Well, a close basically. So you'd want to see if we close below this level, which is 1450, and we start getting a close, then that's going to put this trend into question, because we'll have a lower high. You know, we've got lower lows right here. You can see here's your low, and a higher low, and then this even is a higher low. So we have higher highs. So still a bull trend. But you know, working its way down to kind of a low. But we've still held the trend. So still looks good from that perspective. We did break this 1570 support on the weekly. So that is something to keep an eye on. We had this as support on the weekly chart, and we broke that, and we closed, well below that. So that is going to be resistance, but at the same time we have this trend. So we have to watch. Maybe we even come down all the way to this 1450. We could come all the way down to 1450 on gold price and still keep the bull market trend intact, as long as it doesn't make a new lower low right here. So that's something to keep an eye on. Here's Barrett Gold. Here's your trend. This is kind of your bigger picture trend line, and you can see we've got a couple tags right here, and we basically have we still have some support ranges. So we could, this gap right here, 1460, 1450, is a very high probability area where support will be found if we get down there. So watch for that next week. We should, if we're going to sell off more, we should run into major support right there. And still, the chart looks okay. I mean, we are, still working our way higher. Now, we did make a lower low, basically. Here's your low point at 1607, and we closed at 1567. So a lower low, but just barely. You need to see a little bit more data than just that, And to me, this still looks bullish. If you look at the chart, you can see we're still in an uptrend, still working our way higher. So we saw a lot of selling come in last week. Perhaps this is margin covering, margin calls, covering positions. We don't know exactly why the selling came in last week, but the point is that gold is still in a bull market, and you need to trade that accordingly. So I think we go higher from here. I think we, have seen most of the selling in these miners, but again, I could be wrong. So trade your position size accordingly. And then also, if you're going to trade on margin, you need to, be ready to be margin called. These miners can be volatile. Everything is volatile right now, so margin calls can fire off. I don't, own these miners on margin, so for me, it's not a big deal. Here's AEM. Let's look at the bigger chart. We saw a lot of buying in the last minute here. This thing pretty much broke the this bullish trend that I could find. So at this point, we've got the lows right here to signal kind of a change in trend. So we still have higher lows. Here's a high, a little bit of a higher high, and so we need to hold this 32.46. And if we can't hold that, then could be in a the trend might be over. So again, keep an eye on that. GDX here. I was looking at the 1 minutes because I was kind of watching these on Friday. Yeah, lots of selling in the GDX. And the chart, nothing looks, I can't say that these charts look bullish. A couple of them still are bullish. The bullion, Barrick still looks okay. GDX doesn't look bullish. It looks like a big flush out move. But again, you see these moves in gold sometimes, so you're going to have to just trade accordingly. Sabina, we held support right here. Here's your support right there. You can see if we scroll out, we've got some support right here, support here. We held it right there pretty much to the penny, 63 cents, and started to bounce. So that should hold. We'll see if that actually does, but that should hold. Could be a good buying opportunity. You also have downtrend support, downline support right below it, but that would break this support. So I think we hold right here. JNUG, I bought this one at the last minute of the day. I bought this. I was watching this earlier, and it was just on a complete flush. It was down like 75%. And so that piqued my interest, seeing this flush out. We saw volume. Let's look at the volume here. This is something, again, you always want to pay attention to volume. Look at the volume in JNUG. Let me try to find a chart that I can actually show it to you in. This line is so weekly volume. That'll give us an idea. And it's hard to see because the sale price, flushed down, but the volume is right here, all the way up here. This is your peak volume. Let's see if I can see this in the daily. Yeah, you can kind of see it there in the daily. I need to adjust my, see if I can go to full screen mode. Yeah, there you go. Oh no, that doesn't show it either. I can see a shadow, but the volume is right here. Sorry, it's hard for me to show it, but there's the volume is right there. So that's capitalization volume. That's what that looks like. I think the selling's over in this thing. And this is the most volume I think this thing's actually ever had, to be honest. When I was looking at it, this thing hasn't been around forever, but going back October 2013, your volume was a capitalization volume, the most volume it's ever had. So this thing, there was just an absolute collapse in this JNUG, these junior miners. So I bought it at the very end of the day, bought it. I didn't buy a lot because the volatility is high. You don't need a lot. So I bought, just to get, to give you guys an example, I bought $1,000 worth. And in the after hours, I was up $650. I bought it, and in the last 2 minutes or so, and in the last minute I was up $400, and then in the after hours I was up $600. So 60% gain on my position, on my entry. I think we're at, I think that was the end of, that was capitalization, and I think that was a good entry. So we'll see what happens on Monday, but ultimately I think that was a major flush out move, and the selling is over. Everybody threw in the towel on that, and that's when you want to be a buyer. So again, if that works out, have a 60% gainer on $1,000. I mean, it's not a lot, but $600, whatever, it's cool. Silver looks good as well. SOV, we tagged support right down here. If I zoom in, you tagged it right here at 1347, and you can see we had support right there. Lots of support on the daily chart. Right there at 1340, we tagged it and started to move higher, and we actually closed right here at this 1369. Sorry. So that looks actually like not a bad entry. So I might jump back into my SLV now that it's kind of held support. I want to see how it trades out on Monday, but I suspect Monday is going to be a move higher, just because of this flush out move that we saw in the metals. I think that's over, and I think the buyers are going to step in. So that's really it. The point that I want to make out is that, I do think gold is a good trade. One of the reasons, and what I've been hearing out there in YouTube land, and it's something I believe in that seems to make sense, is the fact that the bond market has been the safety trade for 40 years or so. Every time the bond market has moved, every time the stock market has moved lower, people rush to bonds to find safety. And that makes sense because bonds have moved higher as interest rates have moved lower. But the thing is that trade, I believe, is over. I think we're entering a new decade, a new era around bonds. And if you look at the federal funds rate, basically that's because interest rates can't move much lower. So interest rates, they because they can't move much lower, bonds can't go that much higher. So money is going to start to look for other areas of safety, because there won't be a lot of safety in bonds. There won't be a reason to buy bonds. If you buy bonds and they can't really move higher, why not just hold cash? And so money's either going to move into just cash, or I think money's going to move to look at gold, because this number one safety trade is usually bonds and number two is gold. So I think that a lot of the bond money over the past 40 years that has moved into bonds, because, going back to 1981, interest rates have fallen every single time there's been a recession. We've had massive drops in interest rates, which means bonds have been moving higher. So bonds have been in a bull market since 1981, and I think we're coming to the end of that 40-year, that long bull market, that big bull market. And so now when there's recessions, money is going to look for other areas to go into, and I think that's going to be gold. So, and there's a lot of people that think that, and I think that makes sense. Logically, it makes sense. Whether it plays out, we'll have to see. Anyways, long video. Wanted to point that out. I don't think it's time, to summarize, I don't think it's time for bargain shopping. I think it's time to I think you still sell the rips. Let this bear market play out. Lots of opportunity to make lots of money on the downside. And there will be a time when bargain shopping makes sense. We're not there yet. I really don't think so. So I think the way to play this is gold mining stocks, gold, shorting the market, cash, and you can buy bonds if you want, but I just personally, I don't think that's the way to do it. So I think that's my game plan. That's my opinion. Anyways, guys, then that's the technicals. So fundamentals don't look good. The technicals don't look good on the stock market. The technicals look okay on gold. They don't look great, but we'll have to see what happens. On gold, they look good. The gold miners don't look good for many of them. So we'll have to see if that changes, and we'll just play it by ear for next week. So anyways, thanks, guys. Thanks for tuning in. Subscribe, give me a comment, like, and I'll catch you guys on the next video.